I'm Mike Gallagher, Director of Research with IDEAglobal. We want to have a look at our key foreign exchange views for 2014. Amongst a number of the key calls are dollar yen going to 110 by the summer of 2012, sterling undertaking a re-rating as we see a scope for euro sterling down to 79, and a generalized dollar rally across the board, not only the yen and commodity currencies, but then as we sort of go into the second half of 2014, that can extend still wider to the European majors. The key driver for 2014 will be central bank balance sheet expansion. In the G3, the balance sheet expansion could actually be faster than 2013. Although the central prospect is for the Fed to taper through the course of 2014, the Fed will still be expanding its balance sheet. Meanwhile, the Bank of Japan, we project, is likely to accelerate its purchases by the spring. The key is actually really the ECB. During 2013, the ECB has shrunk its balance sheet by more than the Fed and the Bank of Japan have expanded their balance sheet on a combined basis. This significant reduction in the ECB balance sheet is likely to be reversed. We'll see an expansion through 2014 as we see a succession of shorter term LTROs up to 12 months, and then eventually in the second half of the year we'll see a bumper multi-year LTRO which is focused on real sector lending. This is all going to be designed to try and boost the flagging Eurozone economy and to beat the disinflation threat. So globally, markets will be supported from a risk basis by this overall G3 trend, but it does mean different trends for different currencies. Fed tapering will produce a dollar re-rating generally, and especially against the commodity currencies. Dollar yen we see to 110 by the middle of 2014. The euro strength will eventually give away in the second half of the year as the ECB capitulates, and the Bank of England will delay tightening into 2015, but rate jitters can produce a boost to sterling. Looking at things in a little bit more detail, one of the counter arguments to the euro-dollar story that we're talking about is that the European current account surplus is likely to remain very high in 2014 and 15 and could actually produce a strong euro. The evidence is very mixed, however, in terms of the relationship between the euro, whether it's euro dollar or the euro trade weighted, and the current account surplus as is showing in this graph. Instead, we prefer to look at the interest rate differential, which has had a better relationship on a longer term basis. The prospects are that the spread between sort of Germany and the US at a 2-year area will actually go more in favor of the US, and this will ultimately prompt a snapback in euro dollar. If we turn to the charts, our chartists are also very clear that we're coming towards a medium-term high in terms of euro-dollar on the monthly charts, and that the overall chart patterns do suggest a resumption of the bear trend and a breakdown for the euro through the course of 2014. Dollar yen has been sort of something that the market has had significant fortune with through the course of this year, particularly in the first half of 2013. The relationship between the Bank of Japan's balance sheet and the Nikkei are pretty well known, and with the prospect that the Bank of Japan will accelerate the process of asset purchases in 2014, we could see a still greater re-rating for the Nikkei. In terms of the market, however, I think one thing that also needs to be looked at closely is the relationship between the Bank of Japan and the Fed's balance sheet and dollar yen. If we look at the course of this year, the Bank of Japan has actually accelerated its balance sheet expansion somewhat more rapidly than the Fed. Dollar yen has, if anything, anticipated this and run ahead a little bit. But with the prospect of the Fed starting tapering in either January or March, and then probably ending tapering by the end of 2014, we could actually see a significant balance sheet expansion for the Bank of Japan relative to the Fed, and that this could point to a $110 yen, particularly given the prospect of further Nikkei gains as well. I think we'd highlight this as one of our clearer high conviction trades for the first half of 2014. Elsewhere, other trades that we particularly like are euro sterling. Although there is a bit of a external deterioration in sterling, we still think that the pound is undervalued on a long-term fundamental basis. For example, euro sterling should be properly valued more around 70 than current levels. And as we see the focus switch towards 2015 tightening from the Bank of England, we think that the pound can undertake a re-rating. In the first half of the year, the best way to play this is against the yen. Sterling yen certainly has scope to 180, we think. But in the second half of the year, we can see a sub 79 euro sterling as well. Turning to the Swissy, I think if we look at Euro Swiss at the present moment in time, there's a big sort of contrast between Euro Swiss and what's happened for other safe haven counters. 2013 has seen a large capitulation not only of the yen, but gold and US treasuries. In contrast, the Swiss franc, whether it's measured in Euro Swiss terms or in terms of the Swiss trade weighted, has not really seen a substantive shakeout. Indeed, you have to go back to 2011 and the SNB's introduction of a floor on Euro Swiss to really sort of see any sharp movement. We think there's a bit of a delayed reaction that we will see a weakening of the Swiss franc. Previously, from the 2009 period onwards, there was a significant correlation between the stress in the Eurozone, as proxied here by the EU banking CDS, and the level of the Swiss franc. As stress has come in, particularly in the last 18 months in Europe, and been reduced, we haven't seen the unwind. We think that this can come through, and it really is just a matter of time, and this time is likely to be in 2014. One of the clearer trades in the first half of the year for us is Euro Swiss, where we look for a move to 126. Turning to some of the commodity currencies now, the generalized view we have is of a dollar re-rating. We think that the dollar has a phase where we can see a re-rating sort of occurring relative to the secular weakness that's been evident over the last 10 years. On the charts, our chartists are pointing out that we're at very crucial levels at the present moment in time, but it does look as though we'll see a breach on dollar Canada, which will initially take us to 109, then to 111, and potentially substantively beyond there. The Aussie dollar has seen an adjustment through 2013, but still has quite some way to go. I think if we look at the Aussie, one of the things that has been supporting the Aussie dollar in the last 18 months is the tail end of the investment boom. That's now ebbing, and we're likely to see the underlying current account position and current account problems coming through. This can produce a downdraft in the Aussie dollar. We see sort of scope over the next couple of months to see 88. And the picture beyond that is for further substantive losses of the Aussie dollar. This is Mike Gallagher from IDEAglobal. If you would like a full copy of the report, then please email efeld@ideaglobal.com. Thank you very much.